Hello there! So, recently there's been a bit of a discussion about the 10% stake in Intel that was acquired by the US government.
I abhor this idea. I really do. Intel should have been sold for car parts 3 years ago. Why would anybody want to own this thing? Take it behind the barn and shoot it.
Well, I think it's fair to say that the topic is a bit contentious, but what exactly was the deal actually about? So, Intel has in the past received some grants from the US government, most prominently from the CHIPS Act, which passed under Biden. The idea was manufacturing chips is pretty important, so let's give out some government money so that they build the chip factories in Arizona instead of Taiwan. Due to about 3 years later, Trump is now in office, does not like the CHIPS Act, and especially seems to not like the current CEO of Intel. Well, they end up meeting and apparently settling their differences because Trump walks off with like 10% of Intel. Well, not he himself, but the US government does. But aside from the question of whether or not this is good politics, the concept itself has some appeal. Shouldn't the government, and thus the citizens of a country, benefit from the success of the companies of their nation? After all, it's the people and infrastructure that they've built that makes that success possible in the first place. Well, the answer is yeah, they probably should benefit, but how much exactly? To figure that out, it's probably smart to look at how much the government already gets from the success of their companies. So let's illustrate that with a simple example. Pretend we have a company that produces, tires, like the ones on cars, and they have a revenue of about 10 million. Now, obviously they have a bunch of costs as well, but let's say in the end they end up with a healthy profit margin of 10%, so that gives them about 1 million profit each year. How much would the government benefit from such a company? Well, in most countries, companies have to pay what is called a corporate income tax, which is essentially just a percentage tax on all their profits. This tax can vary from country to country, but for simplicity's sake, let's just say it's about 20%, which is close enough to the US one. Now, already the government's got about 200,000 of that initial 1 million in profit, which leaves the company with about 800,000 after tax. This money isn't really useful to anyone if it's just sitting in the company, so usually companies want to distribute this to the owners or the shareholders. The way that this is usually done is through dividends, which are taxed as capital gains. Capital gains tax is kind of variable based on your situation or your country, but this is just an example, so for simplicity let's just say it's 20% also. So, just from the dividends, our example government gains another $160,000 in revenue. And these are just the taxes that are paid on that 1 million of profit. But if you think back, we had about 10 million in revenue, and of course some of that will also go towards taxes. So for example, any wages paid will be subject to payroll tax, and the income that results from it will be subject to a personal income tax on the employee's side. The property on which the factory is on is subject to the property tax, and nowadays, if they import any of the materials, it will also be subject to tariffs. As you can see, all of this adds up, and it would already get a bit complicated to calculate all of this here, but it doesn't end there either. Because when companies do well, their owners get richer, and when people get richer, they spend a lot of money on stupid stuff like boats, for example. And this consumption in turn stimulates the economy again and provides for more taxes, and there's all kinds of second order effects that are nearly impossible to calculate manually even if we try it here. Okay, but if it's so complicated to calculate, how can we figure out how much the government is actually benefiting? Well, it turns out there's a really cool paper by L&J Auerbach, which is called How Much Equity Does the Government Hold? I don't want to bore you with the details here, but I think the methodology is really cool, so I'm gonna give my best to give it a super simple explanation here. Essentially, what Auerbach does is he takes a look at the inflation-adjusted US government revenues and also the stock market returns. And he takes this data and fits a time series regression model with it. What this does, essentially, is it gives you the estimated impact of a 1% gain in the stock market on all subsequent years of government revenue. Okay, so how much does the government gain then? Well, at least according to this paper, a 1% increase in the stock market leads to an increase in the net present value of government revenues by 7.5%. Well, what does all of this actually mean? So, the net present value is a concept that we use to account for the fact that having money today is generally better than having money tomorrow. If I offered to give you $10,000 in 10 years or $5,000 today, you might prefer the $5,000 today. And the same goes for the government. And because the stock market gains generally have positive effects that last for much longer than just 1 year, we also apply the same concept to the benefits that the government gets from it. So, in really simple terms, what this tells us is that when the stock market rises, the government revenues rise a lot more than that. But you might still wonder, how does all of this lead back to our title of the government owning 180% of the stock market? Well, because we have hard numbers of both the US stock market capitalization as well as its government revenues, we can actually compare exactly who gains how much from a 1% gain in the stock market. Luckily, the author of the paper has already done the math for us, and it ends up that the US has implicit equity holdings roughly about 1.8 times the size of the US stock market. Obviously, there's a lot of assumptions and some caveats to this, but if you're more interested in that, I've put a link to the paper itself in the description. Also, obviously, the government doesn't directly own all of the stock market, because if that was the case, then nobody else could own any stocks. But what we actually mean is that the government, through its right to raise taxes, has sort of an implicit stake, much like a silent partnership, in every form of economic activity that happens in its country. This paper shows that the size of this position is really significant. For example, the 10% of Intel that we mentioned in the intro is vanishingly small compared to 1.8 times the value of the entire stock market. Even though the paper is a little bit dated, I found it really interesting, and if you have any questions, leave them in the comments, I'm happy to answer them.